Well, hello traders and welcome to this week's update. I'm going to cover a few instruments in this video, and what I've done is I've put on chapters and you can scroll along the sort of video slider bar thing and you can scroll to whatever you're interested in. But if you're interested in the markets overall and what the dollar might be doing and commodities such as oil and gold and natural gas, and if you're interested in currencies, then you may as well watch the whole thing. So let's start off with currencies. And as always, I'm going to have a look at the dollar index to begin with. And what's interesting about the dollar index is that we've got this potential double bottom, and so far it's tried pretty well to hold above this low here at about 100.8. And over the last week, we've just managed to consolidate above 101.7-ish. And you can see the whole week we've actually just moved sideways. The problem is that we're forming a sort of a descending triangle here, and there's a bit of weakness in this, and every time we try to break up through this 20-period moving average, the market just falls back down again. As a result of that, it may be that we have to retest this level again, and that's going to be the crucial point. And what could happen is that we move back down in the dollar index, back down to about 100.8, and potentially form a double bottom within a double bottom. So the larger double bottom would be this test of 100.8 over here and here. And we might have to test it a third time, which would really form a triple bottom, but it would be a kind of a double bottom within a double bottom, if you know what I mean. So we'll have to see what happens with that. I have the idea that the dollar actually might strengthen a little bit further, and we might get another breakup through these resistance levels up to about 103, where these two moving averages are. That's the 100 and the 50-day moving average, and previous support over here. So that's a pretty key level at about 103.50. And with a bit of luck, we could move all the way back up to about 105.50 or 80, thereabouts. There isn't a lot of consensus about what the dollar's about to do next, and obviously that's going to affect the euro and the pound and the Australian dollar, Japanese yen, and all of the major currencies against the dollar. So we'll have to see. If we do get a breakdown below 100.8, there's every danger of the dollar falling back down quite sharply below 100 and then further downwards. And that could take us down to this next support level at around about 99.50, which was where this previous resistance was, and potentially even further down. So we'll have to wait and see what happens. Of course, there's also the chance of a false break below 100.8 and a spike beneath there to clear out some of the long positions which are now building and make space for the market to continue rallying up from here. Overall, however, I think that we've got a chance of the dollar having another go to the upside. Remember that this level here is a very, very key long-term support level. And you can see that by putting a monthly chart up. And even though this level's not perfectly defined, it's definitely an area of interest for the dollar. And you could say it's kind of the median level for the dollar to be at. So anything above about 100, 100.5 where we are now, kind of bullish for the dollar. Anything below that might be bearish for the dollar. But so far, we're holding above that level, trying to form this double bottom. This is a monthly chart. And on the monthly chart, we've got a little wick low. This month isn't completed yet. And on the weekly chart, if you have a look at last week's candle, we had a procession of bearish candles, 1, 2, 3, 4, 5, 6, 7. And that's a key number in candle sequences. Often 7 consecutive candles of the same nature, bearish in this case, signals potential chance for a reversal. And last week's candle, as you can see against that support level, formed a beautiful wick low. And it's also the 100-week moving average just below us. So we'll have to wait and see what happens. However, overall, I think the dollar has a chance of recovery. So we need to translate that into where we think the euro and the pound will go. And what I've got here is a daily chart on the euro. And you can see that we've tried to move down. We've come down to the daily 20-period moving average. And we've held above there for a number of days in a row, in fact, over a week. We've just held above there, forming wick lows on the daily chart and then just starting to move up. And actually last week, just forming a higher high, ever so slightly, and a higher low. We're up at the 50% retracement level. Above us is the 618 and the 786% fibs, before moving up to the high a few days ago. If the dollar does manage to strengthen, we should see the euro begin to move down from these levels, but we may have to test the 61.8% Fibonacci level and perhaps even the 78.6% Fibonacci first. These are the levels that I'd like to sell into. We're already short the euro, but it is possible that we'll have to look at adding shorts up at these levels here at about 1.104 and at 1.101. So those are the levels to watch out for. If we do manage to break up through the 78.6, always the last chance Fibonacci, one of my favorites actually, and often a good place for a powerful reversal to take place. We do manage to break up through there and through this high, and we have to allow for moves up to 1.11 and perhaps even higher than that. So it all depends on what happens with the dollar overall against the major currencies. I'm going to briefly look at the pound and the Australian dollar, but these will follow suit. Whatever the dollar index and the dollar overall does is likely to affect all the currencies in a similar manner. And the pound formed a hanging man potential reversal candle after 2 wick highs against this very key resistance level. As you can see, going back to, January at the beginning of this year. And we've just sort of bashed up against that level several times. We haven't managed to close above there yet. And so whilst we're below 1.2450, thereabouts, we're bearish on the pound, and we've got a short position on the pound against the US dollar. I think the Australian dollar is actually the clearest of all of them right now, and I rather like this pattern. And if we get a rally up into this green zone, perhaps just spiking up into this green resistance level, you can see why I've drawn it there. Not only is it a rising resistance sort of channel, but the 100-day moving average is up there as well, just underneath there. If we can get a move up into there, maybe a slightly higher high, it'll be a good opportunity to sell the Australian dollar for a move down back into this current channel, and then potentially a break beneath there and a move down to some of these levels. I think the Australian dollar has the potential to be the weakest of the currencies against the US dollar. If we don't get a rally up into this green zone, or at least to the underside of it, or to these highs here, more or less where the 100-day moving average is at 0.68, then there might be an opportunity to sell the Australian dollar on a breakdown beneath this channel bottom, and perhaps this low here at 0.6625, and a retest, a bounce back up from the underside, a retest from the top, and an opportunity to sell there. And you could either do that off daily, hourly, or 4-hourly charts, waiting for reversal candles to take place. On Friday, we did have a bearish engulfing candle off the 200-day moving average. So whether we'll get up there or not, I don't know. It's possible that early next week we'll just fall back down to this channel bottom and then potentially break down beneath it, retest it from underneath, and proceed on downwards. That would obviously be my favorite scenario, considering that we're already short on the euro and the pound. We don't want to see those rallying. So at the same time, we don't want to see the Australian dollar rallying either. And we'd prefer to sell the Aussie dollar on a break below the channel rather than a test of the top of the channel. So that's the major currencies. And I've actually put some of these notes up on Twitter. And if you'd like to go and have a look at some of these analyses and charts on my Twitter channel, the handle is ArcisFX. When it comes to the yen crosses, I think the interesting ones here are the euro against the Japanese yen and the Canadian dollar against the Japanese yen. We're already short both of these. And this one, the Canadian dollar yen, has been moving down. We've got some support beneath us. That's why we saw that spike low bounce on Friday, because we've got a confluence of 3 moving averages, the 50 period, 20 period, and the 100 period moving average. But if we can manage to get down through there, we should see a move down to 97, and then potentially down to about 94 or 95 on the Canadian dollar against the Japanese yen. The one that's most interesting, though, is the euro against the Japanese yen. You can see we're up against this sort of really important resistance level here, right up at recent highs in the last number of years. And that's this level here at just below 150, 148.50, 149.50, 149, that sort of region where we are at the moment. And that's the overall view. And once again, we might have a double top within a double top, like we have a potential double bottom within a double bottom on the dollar index. So there's the first retest of that level. Here's the potential double top. And then if I zoom in, it's kind of a double top within a double top. So a pretty powerful resistance level. And we're right up against that now. We're short the euro against the Japanese yen already. Whether we'll break up through here or not, I don't know. There's no sign of reversal just yet on the daily charts, and the momentum remains to the upside. What that means is that we have to allow for this trade to be stopped out and for this to move up to the 78.6% Fibonacci level, which is above us over here at around about 154. And once again, it's the 78.6% Fibonacci level. It's one of my favorites. And often the move off there, if it does reverse off the 786, it's often a powerful impulse move to the downside. And that's what we're looking for. With a bit of luck, however, this double top within a double top will form next week, and we won't move up through 147.40 or 50, and we'll begin to move down from there. And the target for this trade will initially be the low 130s and then down into the high 120s. So that's a trade to look out for, either off this current level at 147.50-ish, or failing that, a move up into 154, and then a quick and fast reversal down from there, breaking down through these previous resistance levels down to some support lower down in the low 130s and the high 120s. So that's all I'm going to say about currencies, and that brings us onto stocks and the stock indices and a couple of individual names that we're looking at the moment. And I think if I was to say to you that I know what's going to happen with the stock markets, or I've got any prediction or any insight or foresight into what's going to happen, you'd have to take that as complete nonsense, because as much as anyone else, I'm completely confused about the stock markets. I do think that the stock markets, the stock indices, have potential to move higher, and at the same time, I think they've got potential to move lower. The market overall is terribly bearish when it comes to the economy, but conversely and paradoxically, terribly bullish when it comes to the stock markets and the stock indices. However, having said all of that, we have a small short position on NASDAQ. We also have a short position on Apple. We had a short position on Nvidia on Friday. We've taken profit on that trade already, but we might be looking to resell Nvidia on a rally. Now, I don't want to go into too much detail because I want to focus on gas and oil and gold. Basically, if you look at these stock indices, NASDAQ's at a critical level. There's potential for us to move up to 13,600 or 700 and perhaps even higher. I don't know. There are some thoughts on this on my Twitter channel. Once again, you can go and have a look at that and some of my previous videos. But for now, we're having a little dabble at a short position. I think the market's looking a little bit weak here. We have not managed to break above this level here. We've got the VIX at the lowest level since the market fell down at its highest point, and we've seen 2 or 3 weeks of just completely sideways, benign, boring movement on the NASDAQ with a number of wick highs, but at the same time, a number of wick lows. And this market right now is going nowhere. Are we going to fall down through the support level, crucial support at 12,800, and then move down into some of these lower levels? Or are we going to burst higher? One way or another, this market's going to burst somewhere, and it could be up and it could be down, and I really have no clue. At the moment, I'm willing to bet a little bit on the downside, and that's all. I don't think there's any great probabilities in taking a bet either way on the NASDAQ. And the same goes for S&P. However, this is a little bit more technically defined, and the S&P hasn't rallied nearly as much as the NASDAQ has. This is about 7% up from the lows. NASDAQ's up about 20% or a little bit more than 20%. And we do have this pretty well-defined channel structure here. If I just zoom out, you can see the kind of the top of the channel there. We haven't reached the top of the channel. We could do, but we're hovering around the bottom part of this channel. We've got a shorter term trend line, this purple one here, that we're just sort of nudging against. We've got this longer term channel line that is just below us. We've got the 20-day moving average just below us. There's a lot of support below us that if we manage to get through, will be pretty bearish for the S&P. The fact that we haven't managed to easily get up towards the top of this channel, or at the very least the 61.8% Fibonacci level at 4,300, top of the channel's now at about 44.5. Then we've got the 78.6% Fibonacci at 45.30. Anything's possible with these markets, but out of all of them, I think the S&P has the greatest potential to fall down. I think next week we'll find out what the short-term direction is going to be, because these markets really need to get moving somewhere. No one makes money if the markets aren't moving, and we can't remain trapped in this range for too much longer. So something's going to happen. It's either going to be a dramatic move to the downside or a dramatic move to the upside. I don't think we're going to be stuck here for very much longer. So we have a short position on the NASDAQ, simply because that's more overextended than the S&P. But when it comes to the chart technicals, as long as we're below roughly 4190, 4200 on the S&P, and if we do manage to break down through some of these levels here, we've got a lot of moving averages below us. Look at how they're all milling around underneath us and just challenging this market to test them, to break down beneath them. The blue one is the 200-day moving average. If we do manage to get through there and close beneath there on a daily and a weekly basis, it should be pretty bearish for the S&P. I saw a video the other day wherein someone made this comment: as long as speculators are so bearish and so negative about the market overall, as long as everyone's expecting a recession for the markets to crash, everything you see on the news and on YouTube, everywhere else you look, everyone's tremendously negative. And the comment on that video was that as long as that sentiment prevails, this market's likely to continue higher. And being a contrarian, as he was, he's saying until everyone believes that the market's actually in a stage of recovery, we won't see the market fall down and we'll continue to see it move up. So an interesting perspective on that. Contrarian view, the market's so negative, everyone's so expecting a recession that the market's bound to keep on moving higher. A couple of individual names that I like on the short side. One of them is Nvidia, and we've been shorting this. We took some good profits on Nvidia last week, shorting from the highs, and we've got this little trend line beneath us, this little purple line, and the 20-day moving average that we've just managed to close beneath. We'll see how that goes. And we might look to sell into rallies on Nvidia again, perhaps up to around about 277, 278, or the top of this channel line or trend line, whatever you want to call it. But above us, we've got this green zone, and the market still has potential to move up towards 300. So we'll have to see how that goes. You can see it's an overbought market and just running out of steam at the moment. If you put a stochastic indicator on here or an RSI or something like that, or a MACD, you'd notice that there is some divergence between the price and those indicators, with the indicators showing weakness and the price still pushing up somewhat, although weakly. So overall, my idea is to short NVIDIA as long as we're below about 300. And the other one is Apple, where we have a similar sort of trend line to NVIDIA. Again, a very overbought market. We've got this resistance level above us here at this green line, which is also close to the 78.6% Fibonacci on Apple too, and that's at about 170. We've been as high as 168 so far. On Apple, if we can manage to hold beneath this trend line and eventually break down below this rising trend line and the 20-day moving average, which is just below us currently, then we should see some movement on Apple down to some of these lower Fibonacci levels and some of these moving averages below us into maybe the 150s, 160s, 150s, somewhere around there, perhaps even as low as 145. We're currently short on Apple, and we'll have to see how that goes. Seeing as Apple is the largest contributor to NASDAQ, I think they're both going to move in the same direction. So one way or the other, both of these are going to be stopped out at some stage, or they'll both be successful. But we have small positions both on NASDAQ and on Apple, and we'll have to see how those work out. All right, so I've got all the commodities here, the ones that I'm looking at the moment, including gold, and I've got Bitcoin on the chart. I'm not going to go into all of them because we just don't have time here. But basically, I'm short on sugar. That's this one on the bottom left. I'm short on Bitcoin. We have exited our short position on Bitcoin, waiting for a bounce to look to sell into rallies. Perhaps up as far as 28,500, somewhere around there in Bitcoin. We're short sugar at 25, and we'll wait to see what happens. I've also put a post up on Twitter about sugar and the latest news on sugar, so you can have a look at that there. On gold, I'm generally bullish. I'm waiting for gold to retrace into some of these support levels. Now you can see there's a plethora of support levels beneath us. Let's start with the big one, and that's this channel line moving down through these recent spikes up above 2000, and that line is perfectly parallel to this line at the bottom here, and we're looking for a move down to the top of this channel line, and that would be at around about 1950, and we'll wait to see what happens there. That would be the obvious place for first support to form. It's a previous high there, and it's the channel top, and normally when you get a breakout, you get a retest of the channel from the top side, and then a continuation of the move. However, I think with gold, this is a little bit tricky because we've got potential for the dollar to be strengthening over the next period. And we've also got potential for the stock markets to weaken. We do see strength in the dollar, stock markets weakening, and probably a 25 basis point increase in interest rates by the Fed coming up soon. Then that could put pressure on gold. We might see a deeper retracement. So I probably won't be buying at the channel top at 1950. I'll be looking for a higher probability opportunity to buy into some of these levels beneath us. You can see where the first Fibonacci level is at 1880 or 1885. That's where the 100-day moving average is currently. We've also got this red support line going back to previous resistance over there and support over here. And that's at about 1920. That's where the 50-day moving average is. And we could even see gold moving back down to test some of these even deeper support levels into the low 1800s. A lot's going to depend on how the dollar trades in the forthcoming period, but overall I'm still bullish on gold. I think if you're going to start taking a longer term position, maybe 1950 is a good place to start, and then adding to maybe 1920, then 1880, and then all the way down to just above 1800. But if you're going to be day trading this as well, you might try at those supports for bounces off some of these levels. But if you're going to be taking a swing trading position or a medium-term view on gold, I'd like to see a slightly deeper retracement to clean out some of the longs. I think we're probably heavily oversubscribed on the long side, and that we need to clear out and clean out some of those long hands by breaking through this channel top down into perhaps 1920, perhaps even into the high 1800s, and maybe even the low 1800s. We'll have to see what happens. But I'll be keeping a very close eye on this, and I think this is going to be quite an active trading period coming up in gold. So we might be in positions long for a bit and then out of them. We might get into trades for a day or two and then get out. We might get out of a few long trades at break even if the market sort of comes back to our entry price. And so we're going to have to be very nimble and flexible and creative in trading gold going forward. I don't think it's going to be an easy path upwards, but I think the general direction is going to be long, and we're not going to be looking for short positions on gold. We're only going to be buying. Quickly, whilst we're on the commodities section, this is soybeans. For those of you who are trading soya, we're short from 1520. We're now at 1440. I'm going to be covering this short position somewhere down into the support here at around 1420. Looking for a bounce back up to this red level here at about 1470, 1480, and then all the way down into 1350 in time to come. If you're a member of my community, you will have seen these trades and you'll know our position on soya. So I'm not going to talk about that too much. So we've talked about Bitcoin, we've talked about gold, we've talked about sugar, we've talked about soya, and that just leaves oil and gas, the two favorites of the day at the moment, oil and gas. Now I've made some interesting observations on oil, which I'm going to share with you shortly, but let's just talk about natural gas. There's not a lot to update on natural gas. And again, I put a tweet up on this and I've actually changed this chart up a little bit just to give you a different view. This is the Fibonacci view, if you want to call it that, on natural gas. And you can see how beautifully this market's traded against these Fibonacci levels. Right now, my position is long from $2. And after this move up to $2.36 and then retracement back to $2.20, actually just below it, about $2.15, $2.16, we bought again. And I've added another 25% of my position onto the current 50% that I hold from $2. That means I'm holding 75% of my desired position size on natural gas. 50% from $2, 25% from $2.20. We're looking for a move up through $2.37 up into the next resistance levels, which are really well defined by these Fibonacci levels. We'll have a look at my other chart without the Fibonacci's shortly, but you can see they're pretty much the same as where these Fibonacci levels are. Eventually, we're looking for a move up through these consecutive levels up towards $3, which is going to be the strongest resistance level before we get up into our target zone, which is between $3.40, $50, $60, and $75, averaging at around $3.50, right in the middle of that zone there. As I've said before, there are a lot of speculators holding on to long positions from about this level and the $3 level. And so we're going to see a lot of profit taking at $3, and we're going to see a lot of profit taking at about $3.50, if and when we get there. It could be a really long time before we do get there. We could be trading between $2 and $3 for an awfully long time. Let's go across and have a look at the other chart that I showed you in previous videos. So this is the other chart that you'll be familiar with, and you can see my resistance zones up above us in green and the support level down below here at $2 and the $2.20 level, which is where we are right now. You can see the last 2 days, Thursday and Friday, managed to close somewhat bullish actually, holding above the 20-day moving average, and both of those days closing up above the $2.20 level, which is our entry level for our second trade. We must, however, allow for a further dip back down to $2. It's interesting as well, if you look at this and compare it to the dollar index chart that we were looking at earlier, that we've got quite a similar pattern, because the dollar index has got a potential double bottom within a double bottom. And here we've got the first bottom there and another bottom there. And potentially we could have another double bottom within a double bottom on natural gas this time, not the dollar index. For those of us who are long already, hopefully that won't happen. We can get a continuation of the move up through these levels, up to first of all $3 and then this pink zone up here, averaging around about $3.50 or 60. Remember that I'm not bullish on natural gas until we get up through these resistance levels, close above them, back test them on a daily basis, and hold above them, breaking up through these consecutive levels above us. We must continue to allow, and I sound a little bit like Jerome Powell now, for a test of $1.80 and $1.50. I think that's become less likely, and I think that the $2 level may have formed a low. However, this move lower isn't over until it's over, and we don't know that just yet. We've got to get through this $2.37 level and hold above there. That's where the 50-day moving average is. That's where this first resistance level is above us. And then hopefully we'll begin to move up from there. If you didn't manage to get long at $2 or $2.20, there's probably still an opportunity to take a long position now at $2.20, depending on where the market opens later on today. Bear in mind that I've taken a quarter-sized position at $2.20. I have a 50% sized position at $2. If you are going to get in the market at $2.20, then remember to position size accordingly, and you could use my idea as a guide. This is not trading advice. I don't want you to copy me. I don't want you to do what I'm saying. I'm not telling you what to do. I'm telling you what I've done, and all I'm saying is $2.20 might be a chance, if you haven't got into this market long yet, to take a nibble at a small position, remembering that I'm only 25% invested at this current level. Now, the market might open higher or lower today. I don't know which way the market's going to open. Often we get weekend gaps, and depending on what news may have come out of the weekend or weather forecasts or geopolitical events, I don't know. I haven't been watching this because I'm invested in these positions already. I'm trading this purely technically at this stage. At some stage during the forthcoming week, I'll take a look at some of the influences on the supply and demand situation. So I don't know how this market will open a little bit later on. It may open higher or slightly lower, or it might just open at the same price. If it does gap lower at the open, it might be an opportunity to get in at a better price than $2.20. If you want to time it on an intraday basis, you can just switch across to your 1 hour or 4 hour charts. Over here, I've got the 4 hour chart, for example, and you can start to look for reversal candles such as these ones that we saw over the last couple of days. You're looking for wick lows or engulfing candles, like that one, engulfing candle there, spike lows, wick lows, that sort of thing. You can look for those on the intraday charts if we gap lower, and then try to time your entry better. I don't tend to trade commodities off intraday charts very much. I do look at the 4-hour charts from time to time, but generally I trade these off day charts, and I place the most emphasis on the daily close, looking at the candle shapes and looking at the levels at which those shapes occurred. So that's natural gas, and if you're interested in drawing this Fibonacci study on your charts, draw it from the low head around about $1.96, and you can see where these levels are. There's the 78.6, the 61.8, the 50%, 38.2% up to the top. And it's really interesting to see how this chart trades against these Fibonacci levels, which now align perfectly with the levels that I had drawn in there on the other chart, which we've just had a look at. So that's the strategy on natural gas, and it'll be interesting to see how this all plays out. And you can also see that the candle shapes on the natural gas futures that I've got on my broker, Black Bull, slightly different to the candle shapes that you saw on the NYMEX chart with the Henry Hub prices. So bear that in mind, depending on where you get your pricing from, the broker, the futures that you're using, which futures contract you're trading. And also remember that spot prices vary across, for example, the United States, and you can get different pricing from all sorts of sources. So it's a pretty tricky instrument to trade from various perspectives. You might have seen the video that I put up on the Orlando versus the futures contract prices and the arbitrage opportunities that come from that as well. So pricing on natural gas is not as simple as it might seem. And you've also got futures rollovers and gapping due to that. So in summary, once again, I'm long 50% from $2, long 25% from $2.20. We're looking for a move higher through the 50 MA, through this first resistance level here above us at around $2.37, and then through these progressive resistance levels, which are also beautifully defined by the Fibonacci levels, up to $3. And when we get to $3, I'll decide what to do next. I'm probably going to cover some of my long positions or hedge my long positions with an opposite short position. I'll decide when we get there, and of course I'll be updating as usual on this channel. The last commodity I want to look at is WTI, crude oil. And we've been trading this short from the top here. We had a great trade on this last week. We were selling after this reversal down into this gap, and we took profit sort of near the top of the gap. We didn't get that last little bit out because I wasn't sure if this gap would provide support. But as it happens, the gap has now been filled, and we've just now tagged this rising trend line beneath us. I have an overall idea that crude oil might find support here now that we've filled the gap, we've reached this trend line, and that there might be further strength in oil as this year progresses. There are a variety of reasons for this, which I don't want to go into now. A variety of fundamental reasons affecting supply and demand, and there are arguments for both sides of it. That would occupy at least an hour or two of video, so I'm not going to do it here. But I think my view on this is that we'll probably find support around about this level here. We have to allow for a dip down to potentially form a right-hand shoulder of a head and shoulders pattern down to these previous lows. That would take us down to about $70, and we're at about 78 now. Expect a little bit of sideways movement for a few days to come, perhaps a dip below the trend line just to clean this out a little bit, get rid of some of the exuberant long positions and weaker hands who have taken positions at this level now that the gap's been closed and the trend line's been tagged. So maybe a bit of a clean out down to perhaps mid-70s, even 72, 73, 74, somewhere around there, and then a resumption of the rally. Failing that, if we don't hold above this sort of outline that I've drawn in here, we must allow for a drop back down to these previous lows at around about $70. So that's the way I'm going to be trading this, and I'm going to be looking for long positions on WTI. And it doesn't matter what you're trading. It could be spot price, it could be futures, could be WTI, it could be Brent crude, whatever you're trading. Overall, I think the direction for Brent crude oil is going to be higher into the rest of this year. And eventually we might even get back over $100 a barrel and even up into some of these previous highs. I don't think this market's going to be as weak as many people expect. And I think there's general bearishness on crude oil, which might also push crude oil higher. But I think there are more fundamental reasons for crude oil prices to find some base, some strength, and to move higher as the year begins to progress. Well, I hope you found all of that very useful. If you enjoyed this video, please give it a thumbs up. And if you're not subscribed to this channel, why not subscribe to the channel while you're here to make sure you get all my videos the moment they come out. Have a fantastic trading week ahead, and I look forward to talking to you again soon.